Hey, welcome to the Closing Beat, everybody. Happy Monday to you. Happy Tariff Monday. That's how we should say it. Tariff tantrums. Isn't that what they called it last time? We are financial advisors here at Jazz Wealth, and of course, we're going to talk about all of that and a whole lot more as we go through this. Are we fighting for the mouse? We're good? All right. Anyways, by the way, if you want to check us out at Jazz Wealth, we got a lot of cool things coming up, and here's a little sneak peek at what our portal is going to look like. We are about to quantify every aspect of your dough. We're working on it now. We're about halfway done. We'll be able to know every aspect of what you do with your money and stop you from making stupid mistakes before you actually make them from every angle of your life. So super excited about that. It's been 5 years in the works, and we are officially working our way through it. So more to come on that one. And also, if this type of market scares you, you look and see what happened today. You're like, okay, I'm getting a little emotional. Why don't you let us handle the long-term stuff? You can hang out for the short-term stuff, keep your own accounts. And of course, we're dead inside. So, there's going to be no problems there. We won't make emotional decisions, but we can talk about the stock market. That is one thing we're pretty good at around here, and one of the only advisors that comes to talk about it. So let's get started. All right, last week, DeepSeek. Oh my God. It was a big thing. If you want to go back and watch the show, it'd be on the other channel though. If you want to check that out, we'll see the discussion wrapped around that, the sort of over excitement or whatever. And this week we end up with tariffs. If you look at the futures markets overnight, it was falling apart. That was pretty kind of wild there. We actually start the day with a pretty significant gap down there. Nobody wins when this happens, but that's what we're doing anyways. So if you look, I'll use the SPY. So here's the ETF. You're following along with this one. Big gap down here this morning, and really around the world too. If you look at China, Canada, EWC is one that you can use there. They gap down as well. Mexico with the gap down ends up coming back positive. Why? Oh, we might have worked out a deal there. The tariffs maybe did a thing for them they were willing to discuss. And China, not as big of a deal there, but they gapped down and actually finished down just over about 0.5%. Now, a lot of simulation or a lot of correlation between what happened last week. Remember last week, if we go over here, this is what happened. This is every sector in the S&P. And we're also, we did include the S&P here as well. Tech sector gaps down at 4.5%. With the DeepSeek. Oh my God, right? It ends up finishing the day only down 0.4%. In other words, we had a rally. Look at every sector almost, and the market had a recovery rally. Some going positive, not all of them, but it was one of those buy the dip type days. Well, what happened today? We had the same thing, although it didn't quite work out like last week. We had, where's energy on there? Down, it was up on the day. So energy finishes up, utilities up, consumer staples, healthcare, communication services. Basic materials actually finished higher as well. Look at tech. Tech starts down 2%, finishes down about 1.3%. Consumer discretionary, that'd be the third one on your chart there, starts down 1.8%, finishes down 1.3%. So not quite the same thing there. And notice how it's targeted. It's focused in an area. We're going to talk about that here in just a second, because these tariffs, although a lot of the bigger analysts out there are like, yeah, this is going to be short-lived, not something we need to really worry about. Hey, it's still there, and that's still part of what's likely going to continue to some degree. Now, I put together a list. Don't know how interesting this is to you, but if you're one of those, you got a portfolio and you're like, oh my God, I got to go through all these and figure out what's going on here and what do I do? Well, I'll help you out a little bit. So here are names with reported revenue of greater than 10% that come from Canada. Right, so you know that companies it's not really a law, but they're loosely required to report their outside of the United States percentage of their earnings. And it has to be over 10%. Anything under 10%, they don't have to report it, so they're not going to make it on the list, although that doesn't mean they don't have exposure to China or Canada. It's just the rules. That's how they have to report. So here's what we got. I'll go through the first one. You can look at the rest of them. Royal Gold, there's the ticker symbol. They're a gold miner. Market cap, and then 35% of their revenue coming from Canada. So also put the performance just to show how it finished out the month and since election day, so you get a feel for that. As you look through, if you see any names that you know, we now know that they have more than 10% revenue exposure to Canada. Take a quick look, because we're going to move on to the other areas here. If we go down to Mexico, although it's not as impactful as this was earlier today before we knew that there's a pause on the tariffs for Mexico. You got Jabil Circuit, very popular around here, 18% coming from Mexico. You might notice AutoZone, if you're looking for some of that. Pilgrim's Pride, you may be familiar with. These guys have a lot of, or more than 10% exposure to Mexico. All right, get a look. Go on to China now, right? China's a little different. So we got to have more than 25% revenue exposure to China. Now, some of these names may shock you a little bit, and then at the bottom, we're going to highlight a little something extra. So Las Vegas Sands, name you probably recognize, they're no longer really a Las Vegas company, so that's why they have 63% exposure to China. A lot of the semiconductors, those are obvious ones there. Another casino, Wynn Casino, 47%, especially in Macau. And this is including Taiwan as well. So we said Greater China here, which I know someone's going to have a problem with that, but that's what it is. That's how we get the data. Looking through, you're going to see, of course, a lot of semiconductors, a lot of them, and they're going to be exposed in Taiwan as well. Now, here's the thing. We said, okay, let's add the two together. Let's just call it Greater China. Here's their revenue exposure over there. So this could have a real impact on each individual stock if something like this escalates or continues even further. However, as far as the market goes, what we want to know is if these tariffs continue or they escalate, what is the expected earnings hit that they're going to take? What happens? You've seen some of these articles where products move from Taiwan to Mexico to Canada to a company here in the United States, then back to Mexico. And all this, every time they're putting these products together, that would consider or would really cause a tariff, right? So really expensive, especially in the automobile industry. They could not survive, actually. So anyways, we look at that and say, all right, we're investing in a whole market. Maybe you have some of these individual stocks, but maybe you're an index investor and you go, well, how much exposure do they have to the S&P? So it's about 2% revenue exposure to the S&P. And I think that's why you saw today where it was kind of like, all right, the way it stands right now, not good news. They could escalate. Any side could escalate. Mexico could not fulfill their end of the deal. And there's that pause on the tariffs right now. So what's the impact? Like how much of a big deal is this? At the end of the day, it is a big deal if it escalates, but at the moment, the way it stands, about a 2% hit to revenue exposure in the S&P. It's not a small number, by the way, but just, something to point out if you're curious or interested in that. All right, let's go to some stocks in the news here for the day. And remember, I'll take your questions at the end. If you have any questions, happy to help there with, whatever you come up with, and I may happen to know the answer. Let's try this. So we're back to that thing with this thing. Let's go like this. It just takes a second to think about it, right? So it got a case of the Mondays. All right, Archer Daniels in the news here. They're going to be laying off some people. They're trying to focus on some cost-cutting efforts there. It's not earnings related, so I thought it'd be fun to bring up. Cleveland Cliffs, very old company, lowered their sales guidance overall, but they said, hey, orders are looking good going forward. Didn't matter. It's still sold off today. A couple others you may be not familiar with. IDEX. These guys do like lab services and diagnostics for veterinarians and anything in the animal space there. Better than expected earnings and beat on revenue as well. So a big day for them. Actually above average move. Trucking company Saia. You would know them if you saw their logo. You can see it in the background there. It's like that red and yellow logo. See those trucks everywhere. Anyways, they beat on earnings as well. Volatile day for them. That is not normal. If that's something you happen to own or taking a look there, that's crazy. Triumph Group is going to be acquired by Warburg Pincus and Berkshire Hathaway as well. $26 a share. It's almost there. That's probably where it flatlines for a while until we get regulatory approval. And Tyson, the chicken people, mostly chicken. Better than expected earnings, and they raised their guidance going forward. Chicken sales are good, and it's not because of the Super Bowl. I think we did this a while ago. If you think that sort of thing is a profitable industry, it is not. The chicken wings are actually the least profitable part of the chicken. They don't make a lot of money on that. And good news, they said there's not going to be a shortage of chicken wings for this weekend Super Bowl. So, hey, good job. All right. Hopefully you like that. Okay, let's do our investor spotlight segment here. All right. We've talked about this in the past. I'm just updating everything as of the end of the month. We've talked about where the stock market is relative to its average. So those of you who are a little worried about a pullback inside of here, I put this in our notes from Jazz this weekend just to highlight this as well. Let's take a look. So in green, we have the S&P through the end of the month. In the light gray, blue, whatever that is, we have the average return for the S&P. All we're asking is the S&P outpacing itself or is it in line with what it normally does? So you can see the 1 year, right now, over the last 1 year, we've got a 27% return, just about. A little less today, right? The average 1 year return going back to 1953 in this case was because we had the 5-day, it's when the market went from a 4-day trading week to a 5-day trading week. So the average 1 year return, 12%. Are we outpacing ourselves? Yes. Over the 1 year time period, the market is very extended relative to its average. Over 2 year time period, average returns annualized 10.7%. We're at 24%. We are outpacing the 2 year return. In other words, we're beating the S&P right now. You're not supposed to do that. 5 year returns outpacing, 10 year returns outpacing. So we're in this environment where the stock market's had a great run. Let's just, kind of include COVID in there and last decade or so, where we now find ourselves outpacing the average return. So in other words, we are extended relative to itself. What do we talk about all the time? We look at stocks and we say, well, that's very extended relative to what it likes to do. When that happens and you see it pull back, okay, it's not like the end of the world. It's normal. It's a reversion to the mean, if you want to sound kind of fancy there. Now, one place this is not true, if you're an investor and you're looking around, if you are a contrarian too, you look at treasuries. They are not on par with their average, severely discounted relative to their average returns. Now, on one hand, you could say, ooh, that's not a good deal. On the other hand, you could say, well, they're discounted. It's somewhere to go. It's something to do. 1 year returns minus 3.2%. Average 1 year returns for the long bond, by the way, 7.9%. You could see over the 1, 2, 5 year period, and I would argue 10 year and 20 year, we're underpacing. And that's just because of the sell-off we've seen since rates started going back up. So are you an investor over there? I'm not telling you what to do, but I am telling you, if you look at this and you see the market, you go, I don't know. Am I really excited about that? I just don't know. Trader time here today. Let's talk about the trades that we did in office trades today. Not many. It was actually a very busy day, right? So not a whole lot to report to you. I'll tell you that those SPY calls, I did sell the SPY calls. Got $1.25 for them. Those were the 608 calls from the position that was the covered call 0 DTE that I did last week. So and that's out for Friday, by the way. PVH, looked at that, sold to put on that one, just to take a chance that maybe you saw them on that list, right? Highly exposed, especially over in China and Taiwan. Just took a chance that this is overblown and maybe that won't continue. Freeport, this is a sold to put with the intent to actually acquire some shares. So we're taking a different approach on that one. And then John Deere actually just bought that back. So it was a short position that we had. John Deere gapped down this morning. I said, well, that's good enough. We made over a 50% profit on that. And that's a really short segment today because that is all we had time to do around here. So we'll move on. Let's call it, you learned it here first. All right, here we go. So each month I like to show historical averages for the market. And I do this in our notes from Jazz. I do something like this, right? So don't let it scare you. We say, hey, okay, let's look at the S&P for all years that we can. What is the monthly average return and what is the percentage of time that it's positive? We're not looking for any magic here. It's not like a crystal ball. We're just going, hey, if February tends to be negative, but slight negative, and only positive 50% of the time over the lifetime, should we be expecting some massive rally this year? Maybe it could happen, but on average, it's just kind of a sloppy month. We look down to September. You've all heard that before. We talk about the September nastiness that we get. Well, yeah, it's because of the stats. That's why you see that on TV. Down 1.17%, only positive 43% of the time. And over the last 50 years, it's about the same thing pretty much across the board. So what we're looking for is to go, well, what do we expect? Do we expect a large pullback? It could happen. But do we expect a large rally? It's also possible. There are positives and negatives inside of those averages. Remember, it is an average. But if it's just a normal year, we don't expect much for the month of February. And what that does is it puts you in that mindset of like, okay, if we have to give some back and forth and all this is going to happen, it's kind of normal for February. And I don't know that I'd make any market specific moves. You may want to add to stocks. There's, of course, earnings season going on. You've got a lot that you can work with there, but that's what you have. In typical Jazz fashion, we're going to do one step further. We're going to go down to how the February for the S&P tends to perform. And we're breaking this down by percentage of the month. So here's the beginning of the month all the way to the end of February. And we're saying, okay, What is the average over the last 40 years? That's your dark blue line there. We tend to see a little bit of a rally at the start. The peak happens about halfway through the month and then a little bit of a pullback. Well, over the last 10 years, remember there's been some strong years in there, same kind of concept, a little more volatile. See in the beginning there, a little more volatile, but we tend to peak almost on the exact same day. And then a bit of a retracement. This is what leads us to go, all right, well, like February is good, it's fine. It could be positive, could be negative, but there's a pattern there. And that's what we're looking for is what type of pattern are you looking for there? Now, I'll expand on this just a little bit. We talked about as January goes, so goes the rest of the year. You've heard that one before? All right, we talked about this in our notes from Jazz just to see if that was actually true. So here's what we did. A little bit of a side topic. So we took all the performance of January and then what happened from February to December. So I'm going to go a little bit slower on this. So in January, here's on the x-axis here, we're going from 0 to some level of positivity. We had obviously a couple good years in there. And then we're saying, okay, well, what if January was negative? So I put boxes around it to make it a little simple because what we're talking about is if January is positive, is y-axis, the rest of the year positive. So as we slide over here, of course, we see more instances of a positive January and more instances of a positive year. There are still some outliers, of course, a little tiny down January and a down year. Down January, down year. Really bad down January and a slightly down year, right? So look at that. We say, yeah, all right, there's the reason why they say that. As January goes, so goes the rest of the year. We have a lot of dots in this little, to oversimplify it, we have a lot of dots here, plus your R squared is trending higher. If we look at the other side, though, if January is not positive, does it affect the year? Not really. More instances of having a down January but a positive year occur than having a down January and a down year. So it's not really the end of the world if we have a down January. We did not. We had a positive January, so all that's good. But this is where they get those stats from. So yes, if we look at a down January, the median return, 3.5%. And by the way, the median return of 3.5% has a 60% positivity rating. So 60% of the time out of the 30, it's positive. It's only 3.5%. If January is up, we have an 86% chance of that is positive and a median return of 13.5%. So of course, we would prefer an up January than a down January. But the point of the story is if it's a down January, does it really matter? All right. It's not like we end up with these massive losses the majority of the time, right? 40% of the time, yeah, we could have a loss there, and that's what you get. So anyways, there you go. Breakdown. We took a look at the stock market. We looked at some stocks in the news, the investor spotlight. You learned it here first, a couple different segments that we're trying out. If you have any questions, I'd be happy to answer your questions as long as I know the answer or can pretend that I know the answer, or maybe Chris knows the answer. I don't know. We will see. While the stream is catching up, I will give you a little review of tomorrow. Because, remember, we're still in earnings season here, and we've got a lot going on. So let's look at tomorrow, just so you're ready. Estee Lauder, boy, you know they're going to be talking about some tariffs there. They'll be reporting earnings. Marathon Petroleum, Merck, Pepsi, of course, we have an office trade in that one. I believe that's our straddle, the short straddle that we have. Pfizer will report, PayPal will report, Spotify, AMD, Amgen, Chipotle, by the way. I believe Kramer was saying, buy Chipotle on any weakness. He was saying that, not me. EA Sports, seems maybe that one, I think they already reported, maybe. You got Alphabet After Hours, Mondelez, and Snapchat. Snap Inc. will be reporting there. So we'll see what happens there. Hershey, we do actually have Hershey in the office trades segment there. Swamp Rat, I'll take that, buddy. Looking 12 years younger with that haircut. I might even put a little something in there for you today, too. I like it. Are the year-end statements out yet? Retirement, or if you're a Jazz client, yes, retirement, the 1099-Rs are out, and I believe the 1099s run at the end of the week or the beginning of next week, no later than February 15th, is what I think I saw there. But yes, they are out and running. Yeah. Oh, I didn't see Planetary After Hours here. What are they doing? You taking my mouse? Me and Cody fight for the mouse around here.
Killing it.
Ooh, 98. Ooh, I'm glad. I'm glad I didn't mess with that one. All right. Good for them. Pushing up against $100, man. Up against $100. I have not seen their earnings. I did not get a chance to look at that, so I can't. I'll comment tomorrow when we get to dig through all of that there. It is a big move, by the way. What do you think of Planet Air moving forward, Dustin? So it's going to open. I mean, it looks like it's pushing for $100. So picture that. Just try to imagine it's tomorrow. We're off the chart, right? So we have this massive run up. We're gapping up higher. Not normal for that to just retrace and give itself up. Definitely something that I would not be wanting to chase myself. And that's if it opens around $100 tomorrow. It looks like it's still even going. So, yeah.
Per share.
Oh, sweet. Wow. Oh, I see. Oh, it's on the chart there. Wow. All right. So getting better and better for them. 8 cents a share, 9 cents a share, 10 cents a share, and now 14 with some good news after. I hope you own it. It's good. That sounds great. We'll go through all of that and then, of course, cover that one for you. What else do we got? Well, you notice that some of the weaker stocks here today were those China exposed stocks, right? The ones we talked about, greater than 25% over in China. Wynn Resorts, one of the weakest ones in the S&P actually for today. So we'll see where that goes. That is an ever fast moving situation. Apple, of course, that's going to hurt them, or that's the assumption anyways, but we'll see. Hey, anyways, I'll wrap it up there. Got to get back to work here. Remember, tomorrow you've got I rattled off all the earnings there and likely some news about tariffs and changes and things like that. So we will see how that goes. You guys enjoy the rest of your day or evening. Thanks for coming over on the new channel here, and we'll see you. Adios.